In this video, we will look at 10 mid-caps and evaluate them for growth triggers. In doing so, we'll look at their financials, tailwinds, where exactly is the growth going to come from. We'll also look at their valuations. So let's begin the discussion by hitting this like button. So the first stock that we are going to discuss comes from my favorite space of engineering research and development, or simply put, ER&D services. I love the companies that integrate product with technology. Let's speak about LTTS, or Larsen & Toubro Technology Services. According to one of the surveys by Deloitte, global ER&D market is expected to grow in the range of 12 to 13% CAGR by 2025 and will be of the size of $63 billion. Friends, personally I think ER&D is a mega theme, and COVID has just acted catalyst in the entire digital transformation journey of organizations. First of all, LTTS has well diversified business presence across the verticals of transportation, industrial products, plant engineering, medical devices, telecom, high tech. So in a way it has significant amount of capabilities already in place to execute the services. Also, if you look at their financials, growth is fast catching up over here. In the last 12 months, the profit growth has been in the range of 33%. Their return on capital employed is more than 30% with EBITDA margins of 20% plus. Though over here, if you compare Tata Elxsi with LTTS, Tata Elxsi might seem an interesting choice, but LTTS provides more diversified option. Also, I will request you to look at the valuations of LTTS. LTTS is currently trading at around 40 times price earning multiples, whereas Tata Elxsi is around 90 times. KPIT Technologies too is trading around 50 times price earning multiples. While 40 times price earning multiples may not provide absolute comfort, but it is definitely better off when you compare it with competition. Like ER&D, insurance is one of the theme which is pretty interesting. We will be discussing about that as well. But before that, let's speak on an engineering company by the name of Tube Investments. This company is part of Murugappa Group. The size of Murugappa Group is more than rupees 500 billion. And has various diversified businesses under it. When we talk about Tube Investments, it has engineering and metal products for the segments of automotive, railway, construction, mining. They also have business presence in consumer segments through cycles. In fact, Hercules and BSC Ladybirds are their brands. Through acquisition of CG Power, they have now also ventured into the segment of products for power industry. Interestingly, just look at the turnaround here in terms of sales and EBITDA post this takeover. Tube Investments are now foraying into the segment of electric vehicles as well through the acquisition of TI Clean Mobility, Celestial E-Mobility, which is a manufacturer of electric tractors. Though personally I think electrification of two-wheelers will happen first, followed by passenger vehicles. Tractors might seem a bit far off, but there is absolutely no harm in keeping one of the interesting businesses on radar as far as electric mobility is concerned. Interestingly, if you observe, Tube Investments have also acquired a stake in the company called Aerostovilos that uses alternate fuels for automotive applications. So all these acquisitions are giving them many optionalities for growth in future. Return ratios of Tube Investments are more than 20%. Debt to equity is at manageable levels of 0.28. Their CROIC, or cash return on invested capital, is around 9%. CROIC percentage is nothing but 3-year average free cash flows divided by invested capital. In fact, if you look at their sales and profit growth as well, it is at impressive higher double digits. Due to all this, as far as valuations are concerned, the company is trading at price earning multiples of 60 times currently against the historical price earning multiples of 30 times. Hence, there might be certain degree of discomfort as far as valuations are concerned. But nonetheless, this is a very interesting business to at least have on watch list. Like growth triggers for Tube Investments, let's now have a look at a company or a business from the space of auto ancillaries and evaluate it for growth triggers. Friends, let us discuss about Endurance Technologies. Endurance Technologies has recently acquired 51% stake in one of the companies by the name of Maxwell Energy Systems. In fact, one of the flagship products of Maxwell is battery management systems, which should give Endurance foothold in electric vehicle space. If I have to explain battery management system, it is the brain of an electric vehicle with the value of around 5 to 7%. Any electric vehicle cannot absolutely operate without a battery management system. For Endurance Technologies, let's look at another interesting data point. 60% of their revenues come from the segment of two-wheelers. In FY19, approximately 2.1 crore two-wheelers were sold in India. In FY21, this number was around 1.4 crores. So in an economy where GDP itself is growing by 7 to 8%, this gap or this pent-up demand of two-wheelers will eventually catch up, friends. In a way, if I have to look at it, Endurance is a very good proxy for two-wheelers in India. In fact, some of their customers are Honda, Yamaha, Hero, Eicher Motors, etc. Semiconductor chip shortages is another issue which is receding and should get better only with time. However, let me add one word of caution here. Europe's recession and slowdown has definite impact on the business of this company. 95% of the products of Endurance Technologies are electric vehicle segment agnostic, meaning with the push coming in the segment of electric vehicles, the products that they make like brake assemblies, suspensions, castings will still be required. So in a way, majority of their business is less prone to disruption by electric vehicles, and I see this as a big plus. On the valuation front, the company is trading at 45 times price earning multiples against the historical averages of 33 times. So this is not a significant gap here. In fact, if I assume here that if the profits return to the levels of 2019 and 20, the price earning multiples will moderate further. However, the margins over here have been in pressure in the recent quarters and need to be closely monitored. Return on equity is also good here, and with auto sales picking up in due course, the business of Endurance should also see an uptick. Let me show you another interesting nugget over here. In the last 12 months, CNX Auto Index has been a huge outperformer against Endurance Technologies. CNX Auto Index has made a gain of 30%, whereas Endurance has lost 9%. While this underperformance does not indicate a definite opportunity, but this is one data pointer that we as investors should keep in our mind. Is this underperformance too significant to stay like this? Now the next two businesses that I am going to discuss with you are platform businesses. Starting with 14,000 crore market cap company by the name of IEX or Indian Energy Exchange. In fact, in future I am planning to do a similar video on small cap stocks with less than 10,000 crore market cap. So as to not miss out on that video, don't forget to subscribe to the channel and more importantly turn on all the notifications for it. Now coming back to IEX, in true sense it represents proxy to power businesses in India which itself are going a structural shift with technology. In fact, power itself is a proxy to the GDP and ultimately growth of a country. And with so many developed economies around us facing headwinds, it makes all the more sense to bet on domestic businesses like IEX. There are multiple optionalities in the business of IEX, starting with Indian Gas Exchange, renewable push by the government, cross-border trade, which all can fuel the growth of the company in the future. Also, the government is coming up with MBD scheme under One Nation, One Grid, One Price, where it is trying to route all the power transactions through the exchanges. This will ultimately mean increase in volumes for a company like IEX. But at the same time, this will also mean new competition or new players will enter the market of power exchanges. Though this may seem like a business threat and there is no doubt in it. However, one thing that we should keep in mind over here is the majority of the market share lies with IEX and it is one key beneficiary of network effects. By network effects, I mean all the buyers and sellers prefer to transact on IEX, and when the entire marketplace is present on one platform, it is very difficult for competition to take away the market share. There is high degree of operating leverage in platform businesses, and sometimes operating leverage can act as a double-edged sword. Meaning, when the business starts showing degrowth, the operating leverage is reduced, it impacts their bottom line, and ultimately market starts reacting to this and the stock price is correct. In the last 1 year, the stock prices of Indian Energy Exchange have corrected by more than 50% from all-time highs and currently available at 45 to 50 times price earning multiples. Their historic 5-year average price earning multiples have been around 30 times. Similar to IEX, CDSL is one such duopoly platform business which represents proxy to growing interest in stock markets. So in a way, you will see a lot of changes happening in the stock price with changes in the perception of stock market. This is an out and out bull market stock. The count of demat accounts in India recently have crossed 10 crore mark. Recently, 2 years ago in March 2020, the total number of demat accounts in India was around 4 crore. While I agree with you that not all these accounts may be active, but this is one good enough indicator for us to judge that equity investing is getting mainstream and in fact is a long-term structural story. Along with capital markets, CDSL has other optionalities in business too, like insurance segment. Why not digitize them? They also provide KYC and e-sign services. As far as valuations are concerned, CDSL is currently available at 45 times price earning multiples against the historical averages of 28 times. Now, I am always fascinated by businesses that have a very unique offering or a niche proposition that helps them differentiate from the competition. Let's talk about Balkrishna Industries. Balkrishna Tires are leader exporter of off-road highway tires. So in a way, these are not your normal tires. These are very specific and particular kind of tires designed for a very specific purpose of agriculture, industrial, or be it mining. More than 80% of revenues of Balakrishna Industries come from exports. In fact, more than 50% of revenues come from the geography of Europe. And in the short term, this can be a big cause of concern. But exactly the reason of sharing such business at this point in time was the idea to have on radar such resilient businesses. Once the business cycle is in uptick, such are the businesses that can outperform the competition. When I look at pointers for growth, Balakrishna Tires are quite aggressive on capex. They have recently commissioned 50,000 MTPA plant in Bhuj, and this entire capacity should be ramped up by the second half of this year. Carbon black plant 2 of 50,000 MTPA capacity is coming up as well. This year management is guiding for volumes of 3.2 lakh MTPA, and if they achieve this number, this will be a significant feat in itself. Interestingly, if you observe, BKT is quite aggressive on branding as well. Ranveer Singh is their brand ambassador. They have presence as sponsors in IPL, Big Bash League. They are partners in La Liga and some of the sporting events in Americas. While I will not comment this point to be either good or bad, but as investors, this is quite an interesting pointer to observe in future how exactly or what they are trying to achieve with this entire branding activity. Now let's move on to the space of agrochemicals, which is again a very interesting sector. However, over here, let me give you one word of caution. One has to be very selective based on the business model of the companies. We have covered one such business with Make in India theme and tailwinds for our Join Button Deep Dive community members. Every month we ensure to cover one interesting business in depth. For the month of September, we are planning to do a deep dive on a business which is into the space of ESG investing or recycling. One way to look for growth stocks is to look for interesting ideas in the spaces which are fast growing themselves. Digital advertising is one such industry which is very fast growing, and now let's look at a business by the name of Affle India. While it may seem that in digital advertising as an industry there are less barriers to entry, and then there is constant threat of competition from the likes of Google, Meta, threat of data privacy policy. But please note, Affle has been in this industry too from last 16 years and is thriving. They have their own AI based algorithm and data available of connected 2.5 billion devices which they use to deliver contextual marketing for their clients. Meaning, for example, if you are someone who likes traveling, most likely on your handheld device, you will be prompted for next best holiday deal either in Kerala or Himachal. For growth too, they keep constantly innovating. For example, they have fraud detection platform, patents on voice-based intelligence, vernacular focus as part of Affle 2.0 strategy. Profit after tax of Affle India has grown at 60% CAGR over last 3 years. In the same period, revenue growth has been around 67% CAGR. They also have experience of inorganic growth through acquisitions of some of the companies like AppNext, Jamp, which either give them product synergies or geographic expansion. For example, through the acquisition of Jamp, they have foothold in the LATAM or Latin American markets now. Now, as far as valuations are concerned, Affle India is trading at 70 times price earning multiples. This definitely seems expensive, and I am not refuting it also. But one thing as investors we should know is that Affle India has always traded at premium price earning multiples. In fact, as a fun fact, if you look at their current multiples, it is trading below the 5-year average price earning multiples. Again, I may be wrong here and significant correction can take place. That is, a significant derating can happen if growth starts to slow down. The point I am trying to drive over here is the margin of safety in this story has always been on the lower side, and one should thoroughly understand his own personal risk appetite before proceeding. Also, please note, this video or analysis is not a recommendation in any form. This video is only and only for educational purposes. Kindly consult your financial advisor before any investment decisions. Now moving on, insurance is one industry which is significantly underpenetrated with just 1% of GDP spent as a premium. This is a significant gap in comparison to countries like USA, South Korea and Japan. So this makes a very strong case for us as investors to look at businesses from both the spaces of life and non-life. We have done deep dive on one such general insurance company by the name of ICICI Lombard. I will keep the link to that video in the description, which you can refer after the completion of this video. Now let us look at proxy from real estate and infrastructure. The StockAdda that we are going to discuss has around 20% plus market share in the segment of wires and cables with more than 80% revenues coming out of it. Yes friends, we are going to discuss about Polycab, Housing Affordability Index, measured by the ratio of property value to annual income, is at the lowest levels of the last 2 decades, from around 5 times to 3 times. Along with this, focus of government and infrastructure projects like National Infra Pipeline, BharatNet, Bharatmala, dedicated corridor for railway freights. This is all going to drive the demand and consumption of cables. India as a country has immensely favorable demographics with young working population, urbanization, and rising disposable incomes. All this will favor consumption of durables and home equipments. This is a big positive for their FMEG or fast moving electrical goods vertical. As far as valuations are concerned, Polycab currently is available at 35 times price earning multiples, and historically this company has grown in the range of 20 to 25% CAGR. So going forward in the short term, if I assume the growth rate of the company to be around 17 to 20%, then in that case PEG is currently available at PEG ratio of 2 times. This makes it pretty neutral, neither undervalued nor overvalued. However, the good part over here is the company is debt free and return ratios are good too. Now let's discuss one stock from chemical sector, and among the investor community there is one clear consensus: China plus one tailwind is very real. Chemical industry globally is expected to grow by around 6%, and domestically the projected growth rate for chemical industry is around 9%. While this may not sound like a very terrific growth rate, but please note there are many structural drivers here like import substitution, China alternative, and one stock in this chemical sector we should keep on our radar is Deepak Nitrite. Deepak Nitrite is a well-diversified company with 60% of revenues coming from phenols and its value stream of products. Remaining revenues come from advanced intermediates, which constitutes specialty chemicals, basic intermediates, and performance products. Over the period of next 15 months, Deepak Nitrite has planned a capex of 1500 crores, and this exactly should fuel their growth going forward. They are also getting into value-added products of phenol going forward, and generally, value-added products offer better margins. Along with this, they are also planning to enter the chemistries of fluorination as well, which should ideally provide many interesting avenues. In the last few quarters, company has faced a lot of headwinds in terms of raw material pricing pressures. But now, with crude coming below $100 per barrel, at least some cool off can be expected. On the valuation front, it is trading at 27 times price earning multiples compared to historical averages of 21-22 times price earning ratios. Deepak Nitrite is a mid-cap chemical company, but one should also start looking at large caps. And this discussion is absolutely not complete until and unless you look at these 10 large caps and their growth thesis. In fact, among these 10 large caps, there is one large cap chemical company as well.